and welcome back to Beta Accounting Tutor. Today we'll be discussing the income statement. The income statement is a financial statement used to describe the revenues and expenses of a firm during the accounting period. Unlike a balance sheet, which only provides a snapshot, an income statement is more like a diary because it displays the increases and decreases over time. Firms may use different terms in their income statement, but every one of them must draw the same picture. How much money did they make and how? How much money did they spend and how? And how much taxes they paid on it. A basic income statement might look like this. In terms of a merchandising company, they get all of their revenue from sales, and their biggest expense might be the cost of goods sold or the money that it costs them to buy the inventory that they sell. Once we take out the cost of goods sold from the sales revenue, we are left with a gross profit, also known as gross margin. Now, once we take out other operating expenses, such as selling expense, maybe what you're paying your salespeople, and administrative expenses, perhaps what you're paying your receptionist, we are left with our operating income. Keep in mind that operating expenses can include other things, such as depreciation expenses and amortization expenses. Once we have our operating income, we need to take out other expenses that are not necessarily related to our operation, such as interest expense on a loan. Once we take those out, we are left with income from operations before taxes. And then we take out our tax expense, and then we'll be left with our net income. Keep in mind that the operating income is also known as EBIT, earnings before interest and taxes. Another term that you might come across is EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. We would get that by adding depreciation and amortization expenses back to the operating income. Now, you might be wondering how this affects the accounting equation. Net income increases the assets, probably in terms of cash and accounts receivable, but how does it balance? Once net income is calculated, the company may elect to pay out dividends to its shareholders, but the bulk of it goes into retained earnings, which is under shareholders' equity. So let's talk about that real quick. One of the more abstract concepts in accounting is the account called Income Summary. It is a temporary account to help close out net income into retained earnings. Since we have to write a new income statement for every period, we have to clear out any balances from the previous periods in the income accounts, such as revenue and expense. I suppose we could just say, okay, new period, new account, let's cross out all the old information. But that's not how it works in accounting. We back out any existing amounts in the income accounts by transferring them into the account called Income Summary, and the ending balance in Income Summary gets transferred into retained earnings, which is a balance sheet account used to keep track of every dollar of net income in all the previous periods. As you can imagine, the ending balance in Income Summary should match the net income. So let's look at an example. Suppose at the end of an accounting period, you have $50 of revenue, $30 of expense. Now, revenue normally has a credit balance, and expense normally has a debit balance. At the end of the accounting period, to zero the revenue account out, you would debit the $50 out of revenue, and the matching credit would go into Income Summary. Now, the expense would do the same thing. We would credit the $30 out of expense, and the matching debit would go into Income Summary. When we total this out, you'll notice that it still has a $20 balance in the credit side for our Income Summary account. That, at the end, gets debited, and the matching credit goes into retained earnings increasing it by $20. So let's take a closer look at the journal entries. Since revenue normally has a credit balance, the ending balance in your revenue account will be debited to zero that out, with the matching credit going into income summary. Similarly, the ending balance in your expense account will be credited with the matching debit going into income summary as well. And assuming that you have a larger revenue than expense, your income summary would end with a credit balance, which will then be debited with the matching credit going into retained earnings. Well, I hope you guys enjoyed this video on the income statement, and we'll see you next time. Don't forget to subscribe and like this video. Thank you.